Wade Johannes from Central Valley Ag is our marketing analyst this week. The fiscal cliff remained in play this week, while the markets for corn, soybeans, and wheat look ahead to key January reports that could add volatility to their prices. We talked with Wade on Wednesday morning about how those commodities could exit 2012 and enter 2013. As we look at corn and soybean markets, I found an interesting thing in your weekly recap last week. You said, talking about soybeans, simply they have a math problem. Explain that.
Well, basically, when you look at where the crush numbers are at and where the export numbers are at, we're way ahead of the USDA's projections. Right now, the crush is running 10% ahead, and the USDA is calling for an 8% decrease year over year. And so, you know, yes, that can slow down, but it has to slow down dramatically on the crush, and obviously exports are running way ahead as well.
Soybeans got hammered a bit on Tuesday. Was that because of China?
Yeah,
part at least?
Yeah, the USDA announced that China canceled 300,000 tons of soybean cargoes, and then an unknown buyer, which is usually China as well, canceled another 120,000. So the market reacted. It was somewhat of a surprise at this time because they just bought some. I think it was just last week, and then the following week they go and cancel some. But that's the way China plays the game.
Right. You look towards South America. What are you seeing there as far as planting progress, weather, what you expect to see come out of that region after the first of the year?
Well, generally speaking, Brazil is off to a great start. I saw one estimate that said that 40% of Brazil is perfect in that one analyst's opinion. So Brazil is probably looking at a crop that could be better than the current USDA estimate. Argentina, just the opposite, extremely wet in some areas. Some areas won't be planted at all. And so that estimate will probably come down a little bit.
You know, some analysts are saying you could see something like 17 when we come into the spring. How are you weighing that? I know we talked about this last week, but as we get closer and as we start to see the progress there, what do you recommend to producers?
Well, you got to remember that there's an inverse in the futures market, and that's telling you that the market wants the soybeans now, not later. Once we get into the spring, we have to contend with the fact that South America's crop is going to be hitting the market. So I'm recommending to producers, let's look at that 50% retracement level. Let's make a sale maybe around that 1550 area for some old crop beans. Probably leave some in case we do get back to those $17 levels, but I don't think it's worth hanging on to everything just in case that happens.
With either corn or beans, what level makes you sweat when you talk about demand destruction? Because some people believe there's not enough rationing yet, and once we get into spring, both on corn and beans, there will need to be more done. What level makes you uncomfortable?
Well, I think on the corn side, I think we are seeing enough demand destruction. I guess the January quarterly stocks report will give us a lot better feel for what the first quarter's feed demand was. Until that, we probably won't know where we're at. That feed number is going to be a huge hinge, higher or lower, in terms of overall demand. On the soybean side, I think the USDA is putting in a carryout, and they're working backwards from there and saying, okay, this is what projections are. We've kind of seen that in the last few years in terms of corn. They'll put a carryout in, then work backwards and figure out what the yield ends up being.
What do you think the expectation is for the January report, specifically on corn? That's where a lot of eyes are going to look when you look at stocks.
It's going to be big. It always is. I mean, I think it's 3 of the last 4 years in corn. It's been a limit move, higher or lower,
right,
not always higher. And so there's just huge implications in that report between the quarterly stocks and the supply and demand final numbers. There's just a lot of information coming out on that day.
You look towards ethanol, there's just not much good news at this point, but crude oil-wise in the United States, for the United States as a whole, good news. For ethanol, what does it mean?
Well, it's interesting. Here in the last week, I came across an article talking about how North Dakota is now the #2 oil-producing state in the country behind Texas. They surpassed Alaska, of all places. And it's all due to the Bakken shale oil reserves. And that's something that 4 years ago we weren't even talking about. And now there's projections that we could possibly be oil independent by 2020. Well, when you think back into the early 2000s, Jeff, and why did we subsidize ethanol as the way we did? It was because of the energy crisis and because we had to produce enough energy to keep up with demand. Well, when you start taking away some of that demand and start talking about energy balance, there's going to be a lot less enthusiasm to support the ethanol industry long term.
One thing you said when you came in this morning is the weather, or at least the conditions, are local, and once you get east of maybe Des Moines, somewhere in Iowa, it starts to turn around. How so?
Well, when you look at one of the things we go through in our winter meetings is talking about, okay, what the drought looked like this summer, and it was all over the entire Corn Belt. Now, when you look at the drought, basically, like you said, east of Des Moines, it looks a lot better. The state of Indiana caught 2 hurricanes since this summer, so they're going into the spring in a lot better condition than we are here locally.